For starters, the Roth IRA is a special type of individual retirement account that comes with a unique set of tax benefits. Most people are familiar with a 401k, which is a tax-deferred retirement account that's offered through an employer. With a 401k, you're able to contribute your pre-tax income, lowering your taxable income for that year in the process. But when you're ready to start withdrawing money from your 401k later in life, that's when you have to pay taxes on your distributions. With the Roth IRA, you're contributing money that you've already paid taxes on, or post-tax income. This means that there's no upfront benefit like lowering your taxable income for that particular year. Instead, all of the benefits happen at the end. Here's the deal. As long as your Roth IRA retirement account has been open for at least 5 years, you can withdraw your earnings tax-free after you turn 59 and a half. Think of your 401k as receiving instant gratification, and the Roth IRA is a delayed form of gratification. You can either take the benefit up front with a traditional IRA or 401k and pay taxes later, or you can grow your money tax-free for your entire lifetime using the Roth IRA by contributing your post-tax income. In most cases, it actually makes sense to have both a 401k and a Roth IRA, especially if your employer offers any form of company match. Some employers out there offer a bonus contribution on top of the money that you put into your own 401k. For example, maybe they offer you a 50% match up until a certain percentage of your paycheck that you put into your 401k. Most Roth and traditional IRAs do not offer any form of match or incentive like that. However, there is a new age platform out there, Robinhood, which does offer this. We're going to talk about that in a little bit, the Robinhood IRA match, and they've become extremely popular for retirement investing as a result of this. But first, we're going to cover the contribution limits for individual retirement accounts that the IRS sets. Each year, the IRS sets a limit on how much money you can contribute to an IRA, and it normally goes up over time to adjust for inflation. For 2024, that limit is $7,000 if you are under 50 and $8,000 if you are 50 years or older. Now, it's important to be aware of the fact that these limits apply to all of your IRA accounts. So even if you have multiple accounts, that does not mean that you can contribute more than the maximum dollar value. Also, your contribution for a given tax year must be made by the tax filing deadline for the owner of the IRA, which is going to be April 15th. That means for 2024, you could make your contributions anytime from January 2024 all the way through April 15th of 2025, potentially giving you a 15-month window to contribute. Now, in addition to these contribution limits, there's also income limitations in terms of how much money you're able to earn while still being able to contribute directly to a Roth IRA. And just like those contribution limits, those go up over time to adjust for inflation. For 2024, if you are a single filer and earn more than $161,000, you can't directly contribute to a Roth IRA. And if you're married filing jointly, that income limit is $240,000. To make things a little bit more confusing, there's also a partial contribution allowed for those earning a high income that falls just under these limits. For single filers in 2024, that is $146,000 to $161,000, and for married filing jointly, that is $230,000 to $240,000. If you fall within these limits, your contribution amount fluctuates and you're able to make a partial contribution. TIAA has a handy calculator for figuring this out, so I would recommend just using one of these free calculators. So for example, a single filer who is 35 years old making $150,000 would be able to contribute $5,132 to a Roth IRA in 2024. These income limits only apply to the Roth IRA, so if you're making an excess of that, you can still contribute to a traditional IRA because there is no income limitation there. You can also do something called a backdoor Roth IRA, which is a way to get around the income limitations. However, that is a bit above and beyond the scope of this video, but feel free to do further research on that on your own.